In this video, we will explore about the Dow theory. This is essentially the grandfather of modern technical analysis. It all started back between 1900 and 1902 with a man named Charles Dow, who wrote a series of editorials. He did not sit down to write a textbook. Instead, his observations were later organized into a formal theory by his successors, William Hamilton and Robert Rhea. Even though this was developed over a century ago, it remains a foundational framework that traders use today to understand how markets behave. Now, let us look at the first core principle, which is that the market discounts everything. Imagine a giant funnel like the one on your screen. Into this funnel goes every piece of information available, such as economic data, political news, and even human psychology. The theory states that the current stock price already reflects all this known information. This aligns with what we call the efficient market hypothesis. It means that by the time you hear the news, the price has likely already changed to reflect it. The second principle tells us that the market has three trends. Think of the ocean. First, you have the primary trend, which is like the tide coming in or going out. This is the long-term movement that lasts for years, either a bull market or a bear market. Second, you have the secondary trend. These are like the waves within the tide. They are corrections or rallies that last for weeks or months, moving against the main tide. Finally, there is the tertiary trend. These are just the ripples on the waves, representing minor short-term fluctuations that last for days. Moving deeper into that long-term movement, the third principle states that the primary trends have three phases. Look at the curve on the graph. It starts with the accumulation phase. This is where the smart money investors quietly enter the market while prices are low. Next comes the public participation phase. This is when the broader market notices the trend, momentum builds, and everyone jumps in. Finally, we reach the distribution phase. Here, the smart money exits to take their profits, while retail investors often arrive too late, buying just before the trend ends. The fourth principle is very specific. It says that indices must confirm each other. In the Indian context, imagine you are looking at the Sensex and the Nifty. For a market trend to be considered valid, both of these major indices must be moving in the same direction. Look at the chart on the right with the red cross. If index A is going up but index B is going down, that is a warning sign. It means the trend is not confirmed and might not be sustainable. The fifth principle focuses on activity levels, stating that volume confirms the trend. Volume is simply the number of shares being traded. The rule is that volume should increase in the direction of the primary trend. As you can see on the graph, when prices go up in an uptrend, the red bars representing volume should also get taller. If prices are going up but volume is low or shrinking, it suggests the trend is weak and might be a false alarm. The sixth and final principle is that trends persist until clear reversal. This is based on the laws of physics. An object in motion stays in motion. We assume a trend is still in effect until we see a definite signal that it has turned around. This helps traders avoid exiting too early. They use tools like trailing stops or moving average crossovers to identify that specific moment when the U-turn happens rather than guessing. To wrap up, let us ask why Dow theory still matters today. Even in our modern era of high-speed algorithms, this theory provides a structured lens to interpret price action. It perfectly blends human psychology with technical signals. Whether you are looking at a simple chart or using AI-driven sentiment analysis, the core logic that Charles Dow discovered over 100 years ago still holds true for understanding market cycles.